Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Sonal Bhutra. Half a percentage point gone now on the Nifty and the sensex. The Nifty is down more than 100 points. Sensex down close to about 400 points. And this is the third consecutive day of losses, right? And it's a bit disappointing because we opened up flat. There was a little bit of a green on the screen. And again, the markets are selling off. So every minor kind of bounce is also being sold into. One level to watch, because we're close to that, will be Friday's intraday low of 24,180. That has been the recent low in the markets. So we're about 40 points away from that. And that, in a way, would be the marker of this range that we've been in. If that breaches 24,180, then it would be a bit worrying.
Yes, and it's a lot about Bank Nifty yet again, right? So the fall that we've seen in the last couple of minutes has also come in because of the fall that some of these big banks are seeing. So Nifty Bank is down 1%. It's HDFC Bank, you have ICICI Bank, Axis Bank, SBI, you name any of these heavyweights, all of them have come off from the highs. They are at the day's low as well. So there is some pressure that continues with Bank Nifty as well. That was the case yesterday. That continues today as well. We do have the other names, the likes of BEL, HDFC Life or SBI Life. So some of these insurance names are also coming for some profit booking, and that is something that is putting a lot of pressure on the markets as well. Only two sectoral indices in the green today. We have the pharma space and the FMCG space. In fact, even FMCG has slipped into the red as we speak. So defensives, they are coming forward, but other than that, the markets are not looking so good for now. We'll see which way things go. But we do have a lot of primary market action. In fact, stellar listings, all three of them. We addressed Vishal, Mega Mart and MobiKwik previously, but let's talk about Sai Life Sciences. They made their D-Street debut at 650 rupees per share, which is a premium of 18% to its IPO price of 549. The company's 3,043 crore IPO saw a subscription of 10.27 times during the 3 days of bidding between December 11th to December 13th. To discuss more on the company's future plans, we are now joined by Krishnam Raju Kanumari, who's the MD and CEO of the company, joining in now. And we also have Shiv Ramakrishna Chittor, who is the CFO of the company. Gentlemen, good morning. Thank you so much for joining in. And finally, the listing is done, so we can get to more out of you in terms of the outlook going forward. Mr. Krishnam, let me start with you. Now that we are through with the listing as well, if you can share your growth plans. The first half saw a single-digit growth for you. What are the plans going forward for FY25 and especially FY26? Now that the debt will be lower, you will be able to finance it with the IPO proceeds.
Look, I think I just don't want to get into the exact numbers yet, but essentially our growth plans remain pretty aggressive going forward. But I'll just point to the market opportunity in front of us. If you look at the global CRDMO market, India is only about 5% of the size of China. So I think the potential of repeating the growth for the industry at large is pretty significant. So I think the opportunity has to be a multi-year, 5-10 year opportunity, and the scale opportunity is significant. And to that effect, we actually do have significant capex plans going forward. We are working on those capex plans along with our customers to figure out what is important for them in terms of technology platforms, scale. So we are actually working very closely with our teams to outline a capex plan, which we will finalize in the next few weeks. We have enough visibility in our revenue that we will be generating internal accruals, healthy internal accruals in the next few years, along with some debt capacity. So we think we have enough capital to fund our expansion for the next few years going forward and to maintain high-level growth as well going forward. And just pointing to you mentioned a flattish growth. If you look at historical numbers, our second half has always been stronger than the first half of the year. And historically, this industry itself is is not quarter to quarter, is lumpy. And so I think we just historical trends-wise, in fact, ahead of in terms of EBITDA growth, even what we were last year.
So Krishna, just as a follow-up, since second half of the year is stronger than first half, with the strength in H2, do you think for the full year you will get back to at least a double-digit kind of a revenue growth? And also, revenues have been a bit lumpy. FY23 was 40%, FY24 was about a 20.4% top-line growth, and then H1 was 5%. How should we read this?
I think you will have to assume that the lumpiness is going to stay in the business. This is just the nature of CDMO business, because Essentially, you're going with the product development life cycle. You're not dealing with mature products. These are about new products launching in markets, coming and going to phase 1, phase 2, or multiple phases based on clinical data. So inherently, these products are not going to have a long-term scope until they hit commercial. And even commercially, you have different phases like launch phase. So there are multiple aspects which make it inherently lumpy. So you'll have to track this business really on an annual or multi-year basis. So I think what you will see is double-digit growths should not be a challenge mostly going forward. But I think the opportunity is much more significant than that as we look at it.
Okay, so double-digit growth is something which is possible going forward. Mr. Chitar, let me get you in the conversation as well. So you are so Mr. Krishnam spoke about the opportunities which are available going forward. What do you think in the near term would be an EBITDA driver or an EBITDA trigger for the company? CDMO is a market which is growing very well. Can you give us a sense of what is the EBITDA margins the street can work with, and what would the capex do to it? What kind of capex are you looking at? How much will you be spending? If you can give us that amount.
Sure. So I think if you look at the 12-month ended September 24, we presented the September 24 data in the document that we had presented to the public. If you look at the September 24 12 months, we've actually clocked closer to a 24% EBITDA, which is up from the number that we presented for fiscal 24, and that is up from the numbers that we presented for 23. So we believe that there is leverage at play in the business. The CDMO business, particularly the manufacturing business, tends to get, provide leverage to the business, particularly when molecules are scaling up. We mentioned earlier that our business has a lot of commercial molecules. We talked about 38 commercial products, which are fairly early in their patent life, which just gives us an ability to scale and grow. And as we scale and grow, we believe operating leverage is a natural consequence of that action. And I think that would help us grow our margin, and growth of margin is a big focus within the organization. The entire management team was focused on that.
Chitar, Mr. Chitar, what's the view on reducing your dependency on raw materials imported from China? Currently, it's close to about 30%. Do you all wish to bring it down? If yes, how would you go about it?
Yes, so I think so the way we've looked at it today, I think every product that is going into a late phase, which is phase 2 and later, there is a very specific activity that we conduct by product, looking at the scope for the raw material. We actually take a look at what can be done, how can this be outsourced. We work with a lot of Indian partners to kind of get these products locally sourced. And as part of an overall strategy, we kind of reduce dependence as products become commercial. There are early phase and very early discovery molecules that we buy. We do have some amount of exposure with China, but I think we are constantly working to reduce that. But we already have anything that is commercial and larger volume. We have now a specific program in place that kind of continues to reduce. And if you look at our historical trends, we have significantly reduced dependence on China, just from a potential disruption of supply.
Just one final question, Krishnam. There is a lot of uncertainty, ambiguity surrounding the US Biosecure Act. It could get delayed, the form may change. What are your clients telling you? And if it doesn't go through, would it be a big hit to the kind of opportunity that lies in front of you?
To be candid, I think if you look at historically last 3 years itself, we've seen a significant change in customer behavior. Post-COVID, I think most companies were looking at diversification of supply chains. I think that was primarily driven by being a single source in the core situation. But over the last 2 years, most of our customers have voiced, even before Biosecure came about, and Biosecure is only 6 months old, a phenomenon, but the diversification started almost 3 years back. And customers have consistently said that they want to have alternate supply chain, which is equal size to China at least, because they want a true redundancy. It's not really China plus one anymore. And I think companies have taken a long view on it. They have not taken a short view on it. They understand China has built huge capacities, but they expect over the next 10 years to build up significant capacity overseas in terms of partners they choose and build with them. So I think this is a multi-year opportunity for partners who do choose to invest with them and work with them. But again, this industry will have few winners. It's not going to be a case where there will be 10, 20 companies benefit. There might be 5, 10 companies. But these companies will be much more integrally involved in the supply chain of global innovative pharma companies. And I think, I really don't think this is going to have a really adverse impact in terms of the long-term secular trends.
Okay, all right. So we'll watch out for that. Thank you so much, Mr. Krishnan and Mr. Chittor, for joining in today with your thoughts and the outlook going forward. That's the debut or the new kid on the block. Sai Life Sciences doing really well. The stock is up 40% as we speak. Let's slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Stay tuned for that. Welcome back. You're still tuned into Trading Hour. It's time to talk about the commodity space. Manisha is joining us today. And for a change, it's not Bitcoin today. Manisha, focusing on gold.
Well, yes, I am. And it's going to be quite interesting to see on how gold behaves after we are done with the most final important event of this year, which is the US Fed meeting today in the evening. The announcement, of course, about the interest rate cuts and the policy and the guidance for 2025 is something that we will be looking for. In the meanwhile, you have the gold prices trading and holding above $26.50 an ounce. Well, the kind of gains that we've seen in gold prices in this year, in the dollar terms, we are up by 28%. In the Indian markets, because of the rupee depreciation, we have seen better gains come in for the gold prices. But either ways, whichever way that you look at it, this is the best gain that you have seen in gold prices since 2011. When it comes to the Indian markets as well, one would have expected that with the all-time high prices and very volatile prices, you perhaps would see some decline in demand, but that clearly is not the case. The kind of gold imports that we've seen between April to November, a 49% of a jump from the previous year, does tell you that in value and in volume, we are looking at very strong gold imports. The month of November perhaps is the highest level on record when it comes to gold imports. The markets anticipate that for the month of December as well, the import numbers would be on the positive side. So last year, the total import of gold within the country was 743 tons. We are already done 780 tons in this year by now. And the markets do believe that by the time we close this year, we could be more than 800 tons, which would be the highest since 2015 as well. So higher gold prices, higher consumption, higher imports when it comes to gold for this year.
Thank you very much for that. Get into a break. We'll come back and talk market technicals. Mitesh Thakkar will join in next. Welcome back. Mitesh Thakkar is now back with us for a quick technical check on the markets. Mitesh, disappointing session, right? No recovery after yesterday's big fall. But how would you proceed with trade from here on?
Yeah. So, good morning again. I think, we're trading below 24,300. That's not a very good sign for me. We did attempt a pullback, I think, around, 10:30, 10:45. And that pullback also ended around 24,300. So, I think once you clear this 24,300, 320 zone, then only play for long term. Otherwise, my idea is to just avoid. We've taken some bearish spreads on the index, buying near the money put and selling slightly out of the money put options. Because the market can get choppy, it's oversold. The PCR is also oversold, but the structure remains weak. So I think play for long only about 24,325. If it starts getting past those levels, take a very short stop, tiny stop at about 30, 40 points. And then go long. Otherwise, avoid longs. Is my idea, and you can always, get into some bearish options aspects.
Okay, all right. So in a market like this, then what are your trades looking like, Mitesh?
Yeah. So on the individual stock side, I think Tata Steel for me is a sell because the STBT yesterday as well, even now it's still weak. So keep a stop at about 147, half 148, and look for a target of around 139. And some of the pharma names, are trying to recover. Aurobindo Pharma looks interesting to me. It's trading above yesterday's highs. So why here with a stop at about 12.25 and a target of 1300.
Okay, all right, Mitesh, thank you so much for joining in today. So those are some technical bets and levels to watch out for on the Nifty as well. But it's time for a short break. SEBI has introduced a new asset class called as specialized investment funds. Firoz Aziz from Andrati Wealth will join in next to understand more about this and who would this be an investment avenue for. Stay tuned for that conversation. Welcome back. You're still tuned into Trading Hour. Well, solar cell players, they've had a stellar run in 2024 with stocks of Premier Energies, Vari Energies and Tata Power rallying up to 170%, largely because India has been in a sweet spot and also on the back of strong demand. Vivek decodes the rally and what lies ahead for these players in the years to come.
Well, one particular pocket of the market that did very well in 2024 was the entire solar value chain. Just have a look at some of the companies that are involved in solar cell module manufacturing and see the kind of returns that they've given to the shareholders. Now, this particular stellar rally can be attributed to several key factors. As India continues to push towards ambitious renewable energy targets, there has been a substantial increase in domestic demand for solar products. Remember, the USA too has seen an increasing demand for solar energy solutions as part of its broader clean energy transition. The Inflation Reduction Act passed in 2022 includes significant incentives for clean energy production, including solar power. Both India as well as the USA are keen on reducing their dependence on Chinese imports, particularly in sectors like solar energy, given the fact that the US has concerns over its supply chain security, intellectual property, as well as its ongoing trade tensions with China. These particular tensions have driven a desire to diversify sources of solar products. India, on the other hand, is positioning itself as an alternative supplier, benefiting from the global desire to avoid over-reliance on China. Both the USA as well as India have implemented policies to curb the influx of cheap Chinese solar products into their market. Remember, players in the India's solar sector are quite optimistic about growth prospects driven by a strong order pipeline as well as expansion plans. Remember, Premier Energy has reported a significant order book worth approximately 4,000 crore rupees. Vari Energy plans to increase its manufacturing capacity from 13 gigawatt to 21 gigawatt by the end of FY27, while Tata Power reported a strong order book of 15,900 crore rupees in its solar EPC business. Its cell as well as module manufacturing capabilities are also being ramped up as far as Tata Power is concerned. Now, talking about the entire solar value chain, remember, China controls 90% of the world's solar module as well as cell manufacturing capacity. This makes China the dominant player as far as the global supply chain is concerned. Solar manufacturers are actively looking for alternate routes to enter the global markets. Remember, pricing as far as solar modules are concerned in China are at a very competitive 9 to 10 cents per watt, owing to the country's massive manufacturing capacity, economies of scale, as well as cost efficiencies. Now, remember, when you're talking about India, the prices are much higher at 16 to 17 cents per watt, and the USA prices are significantly higher at around 25 cents per watt. Remember, when you're talking about ongoing capacity addition, India's largest conglomerate, Reliance, is on track to commission its first tranche of its solar PV manufacturing by the end of FY25. Also plans to scale up its solar manufacturing capacity to 20 gigawatt by CY26. Adani Group too plans to increase solar manufacturing capacity to 10 gigawatt by 2027. Remember, not only them, other players too have evinced interest to set a facility as India's solar manufacturing sector expands rapidly. However, several crucial questions arise concerning the sustainability of current industry dynamics and the challenges that will be posed by increased competition. Remember, India's solar manufacturers, along with their counterparts in the US, are benefiting from a price arbitrage advantage in comparison to global markets, particularly that by China. In markets like the USA, tariffs on Chinese-made solar products have made domestic production more competitive, benefiting the Indian exporters. The Indian government has introduced import duties on solar panels and cells, particularly from China, to protect the domestic manufacturing industry. To promote domestic manufacturing, ALMM is a critical regulatory safeguard that ensures only approved solar manufacturers' products are used in government-supported projects. Analysts, however, are worried about the supply glut in coming years. Will spreads Indian players enjoy be impacted? As the table indicates, when you're talking about valuations, Indian players are actually enjoying a significant premium to global peers, both in India as well as China. Remember, some of the listed peers in other markets enjoy larger product portfolios. Some global players also own separate polysilicon as well as ingot as well as wafer facilities. So going into 2025, it will be a cautious stance that analysts will keep as far as the entire solar value chain is concerned.
Thank you. Very interesting recap of the way it performed in 2024. Get into a break. As we do that, here is some good news for all you viewers. India's business news leader is now just a click away. So we're introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, financial world updates at your fingertips. So download the app now from the Apple Store or the Google Play Store. Welcome back. Now, SEBI has introduced a new asset class, Specialized Investment Funds, SIFs. Now, they will enable mutual funds to deploy advanced investment strategies in open-ended, close-ended, and interval structures. The new asset class will have a minimum investment amount of 10 lakh rupees. To talk more about this, we have Feroz Aziz, Deputy CEO at Anand Rathi Wealth, joining in. Feroz, first, just give us a little more details about this new product and how is it different from what is available, and what would be the investment strategy?
Good morning, Rima. Like you rightly said, this is a new product class. Unlike in the past, the regulator had called it an asset class. Asset classes are equity, debt, commodities. Maybe even today, people indulge in crypto as an asset class. So this is a product class, point one, and it is called a special investment fund, which is a fund which a mutual fund company can launch only. Okay, this, unlike AIF and a PMS, alternate investment funds and PMSs can be independent licenses. As I read this circular, this is a tagged along license with a mutual fund license. That's point one. Point two, what does this investment fund do? As of now, of course, there's a lot desired, but it actually has limits of investing in equity, debt, and even in REITs and InvITs. So these three, it has been spoken about. This circular does not speak about derivative and its exposure, which was the most important thing which I was keenly looking at, because that's what would distinguish it from a PMS and an AIF for that matter, because mutual funds are a very restricted platform. So to answer your pointed question, Rima, this is somewhere between a mutual fund investor and a PMS investor. We are seeing that there are a lot of people dabbling in derivatives in a very unstructured, more speculative manner. Can they come into a structured investment vehicle? I think that's where this whole argument started. And that's why derivative is something which is important. So, but I think this is a very good move, immensely important move to give only these 40 odd companies the license to run an SIF and not make it like PMS AIF, because that then you have thousands of licenses, and that creates even more a non-transparent, confusing environment for an investor.
Feroz, good morning. Exactly, that was going to be my next question, because it doesn't speak about derivatives, and that is something we had discussed at length earlier as well. What would it mean if derivatives actually are specified in this asset class as well? But tell us, generally, you did indicate that there are more things that need to be discussed in detail in the final paper. So will we get more details in the final circular? Is there an indication, and what more could have been added in terms of specifics here?
Sunal, I'm a avid viewer, and most often than not, Sonal, you discuss things which generally get missed out also. So you're really ahead of times because you're tracking mutual funds so closely. And I'm not just flattering you by giving this compliment. Yes, we discussed incidentally on one of the shows also we discussed derivatives, and that has been missed out yet. Why is it important? Is because the AIF industry. I have a observation which really scares me. It gives me sleepless nights as a stakeholder, not an investor, because I don't invest in AIFs. Is because even debt AIFs don't disclose whom they are lending to an investor who has put 1 crore. If you are getting a bond portfolio with 13% yield, would I not want to know whom you have lent to unless I ask you? You're not going to tell me for the reason of non-transparency, so that nobody else should replicate my portfolio. That's how non-transparent it is. Yesterday, I was seeing an AIF portfolio of one of my clients who had externally invested 10 crores and has a 13.59% yield, but there is no issuer information unless seeked. So AIF is not so transparent. PMSs have a regulation on the restriction of derivatives. So I personally think in the next circular, because derivatives is the most controversial topic, I think the regulator wanted to get this off the ground. I'm sure there's going to be a lot of manthan, a lot of debate happening behind the scene, and I'm sure they're going to come up with something which has, for an accredited investor who proves that he is more informed, can you give him leverage limits of 2 times when options in the direct market can have 100 times leverage? You can have 1 rupee option and a 25,000 crore notional on Nifty. Like when you buy 1 rupee option, you're taking a notional contract value of 25,000 rupees of Nifty, or 24,000 as we speak. Can you at least permit 2 or 3 times the leverage on a platform which is more well managed and is regulated and is only given to 44 companies in India as we speak? So I think definitely there's a lot of work happening in the back.
Yes, so we'll await those details very closely. Firoz, in that case, this is something that everyone asked us yesterday as well. Who would this be suited for? Do you think people will start moving out of PMS or from mutual funds? Because this would be somewhere in the middle, right, in terms of risks. And how attractive would this be as an asset class for any investor for that matter?
I think it will be very, very attractive. And I think most people will, in the current retail segment, if they do disciplined investing, they will graduate to 10 lakhs anyway. So any platform which is so revolutionary and has to be forward looking. So today, if you have a client who's got 3 lakh rupees as his overall portfolio, he will be a 30 lakh client. Even if he did nothing for 15 years, added no rupee, if you compound the money at 14-15%, it will get to 10 times either way. So he can have 1/3 of his money in an SIF, which I think is a very, very exciting platform. From where I see it, of course, we don't cater to retail investors. We only cater to clients who are HNIs. But as an Indian, I feel very happy that people will get access to more intelligent investments. That's where fund management skill is very useful and not so unaffordable, because 10 lakhs pe pahunch hi jayega insaan.
Okay, all right. Firoz, thank you so much for joining us. These are the initial days of this notification as well. As you said, there'll be a lot of manthan, a lot of discussions on this. So we'll have this discussion some other time as well in detail when there are more details available, especially on the derivatives bit as well. But thank you so much for joining us with your initial thoughts. Okay, with that, let's quickly take a look at the markets as well. Continues to be where we saw the levels initially. So 24,230, that's where the Nifty is at. It has slightly recovered from the lows, but Bank Nifty continues to be under pressure. In the Nifty pack, we do have Trent, which has made a recovery from the lows. There's TCS as well, which is seeing some uptick. But other than that, there are certain stocks which continue to be at the lows of the day. JSW Steel and Tata Steel. These 2 names are added to that list as well. The stocks which are at the day's low. So we'll keep tracking the market action for you. But for now, we'll slip into a short break. When we come back, we'll put spotlight on the other 2 news listings of the day on the other side. Stay tuned for that.
2, 1. Hello, welcome to Young Turks Reloaded. I'm Shireen Bhan. Hi, thank you so much. Good to be
What have been the big insights that, or the course corrections, the mistakes that you made at Upgrad that you would like to undo, redo with this one?
I always felt that India talent, there's a very large talent pool available. And I think if we do not tap into this talent, whatever we call as demographic dividend will end up being demographic disaster.
Do you believe that entrepreneurship is inherently a lonely journey?
I mean, absolutely it is, Shireen. And it's fair because, you know, you're sort of, in some sense, already living in the future.
It is a lonely journey. I mean, you have your spouse, you have your partner, you have your co-founders, but in many cases, you end up being very lonely. You don't want to be seen as very weak. I've had instances where you are sitting in the office and then you rush to the loo, you have to throw up and then come back and you feel relieved.
The difficulties and the challenges of just getting the team in place to work with technical fabrics and so on and so forth. I mean, what has that experience been like for you as you set this up?
As an early stage entrepreneur, you only have two things. You have momentum and you have conviction. That's it. If you lose one of them, then you have no right to play.
How much of confidence do you have today to say, why the heck not? I just want to do this because I want to do this.
Saying no is strategy, saying yes is execution. And if you are being very, very strategic about what you're doing, you have to say no multiple times.
Welcome back. It's time to get your CNBC-TV18 exclusive. We learned from sources that Karnataka government may be looking to increase duty on iron ore. Sudarshan, who's gathering these details, is joining us now. Sudarshan, what are you picking up?
So that's what we are hearing from sources, that Karnataka government is likely to increase the duty on iron ore mining. And related to this, draft has already been circulated. What I understand, that draft has been circulated few days ago, and the decision on this Karnataka government is likely to take very soon. One company that is likely to be impacted from this is NMDC. For a company of total mix, nearly 35% is contributed from the state of Karnataka. Remember, Supreme Court in the last order had already announced that this duty on royalty will be taxed retrospectively, and that will be from 2005. Now, Karnataka government taking this decision will have the further impact, and we can see that duty on the iron ore can be increased further very soon in Karnataka.
Thank you very much for that. It's been a good day for the listings. We have three of them. We spoke to Sai Services and they said that they're confident that there's no reason why a double-digit kind of revenue growth is not possible, even though in H1 they had just a 5.5% top-line growth. H2 is typically stronger. But look at the other one, MobiKwik, 87% higher on that. It was a smaller issue, but it saw very strong subscription, 120 times. And Vishal Mega Mart, that was literally a mega IPO. The company raised 8,000 crore rupees. It was a pure offer for sale where the promoter Kedara Capital sold their stake by nearly 8,000 crore rupees. But that too saw a 27 times subscription. And this is I had a chance to chat with the management earlier. So it's a pure offline retailer. They're present. They have about 650 stores thereabout. But they've managed a double-digit same-store sales growth in all their stores. And their focus is on affordability. So the average price of their garment is just 200 rupees. That's it, right? So, and 72% of their revenues comes in from their own brands. And they're saying they're using their own brands not as a margin contributor. So typically when you have your own brands, you would assume the margins would be higher. But here they're saying the reason we are focusing so much on developing our own brands is so that we can make garments that are affordable and aspirational. So they're using that lever, to grow their top line rather than just focus on, increasing their own brand contribution to boost margins. We had a chat with the managements of both the companies post their listing. Listen into some key excerpts.
In addition to that, given that we have a full KYC base on a large user base of 160 million users, roughly 60 to 70 million of our consumers are full KYC'd. And on the merchant side also, we have 4.3 million KYC'd merchants. So our distribution of financial products, be it insurance products, be it saving or investment products, or be it credit products, you know, they will be the cream on top of the core payments business. And that is sort of how we expect to continue growing in the manner we have been demonstrating in the last few years.
About 50% of our growth is coming from same-store sales growth, and the balance is coming from new store openings. And if you were to specifically focus on the risks, of course, we would face the challenges, if there are any, on the macro front. We've done that in the past also, and that would always be something which is on the agenda. Equally, I would say that to ensure that we are the best offering for our customers and consumers in a very dynamic and fast evolving retail scenario in India would always continue to be a challenge. So yes, the challenges are there as much as any other consumer businesses, but we remain optimistic about the future.
All right, that's the mega listings of the day today. But quickly, before we wrap, let's take a look at some of the movers that are on our radar. NMDC, we just had Sudarshan telling us there is a possibility of increasing duty on iron ore, so the stock is down around 4.5%. There's been a sharp fall. Look at that, a steep fall from the high, so 5% lower there. Geo Financial Services, the stock is down 3% as we speak. A lot of these metal names are under pressure. So if we talk about Hindustan Copper, that's lower right now. We had JSW Steel in the Nifty pack also, which came off from the highs of the day. Tata Steel is the other one. If we talk about something like an Ashok Leyland, that stock too is lower by 3% as we speak. And the other names from the broader market, Shilpa Medicare, for instance, is up around 3.5%. So pharma names are back in flavor. That's the only index which is in the green as well today. We have Radico Khaitan, which is doing well, so 4.5% higher there. Other than that, some of these realty names continue to do well. So we have Max Estates up 2%, Suntech Realty is higher by 2%, and these are moves on big volumes as well. So just watch out for these names seeing some traction in trade today. But for that, we'll take your leave on this edition of Trading Hours. Stay tuned. Halftime Report is up next.